Let's face it, in today's world, it's easy to rack up debt. Whether it's that new car, your dream house, or those tempting online purchases, it can all start to feel overwhelming. Today, we're diving into a financial concept that can seriously impact your wallet. What is the interest you are paying really costing you? Alright, so you want to buy a house or a new car and you don't have the cash to do it. When you borrow money from a lender, there's this term floating around, interest. And it's not always clear how this impacts what you will pay monthly or in total for borrowing the money. In fact, there are some lenders that go out of their way to hide from you the total cost of the loan by only showing you a monthly payment. Let's break it down. Interest is essentially the cost you pay to borrow money. Think of it like a rental fee. When you borrow money from a bank or lender, you don't just pay back the amount you borrowed, you also pay a little extra for the privilege of using that money for a certain period. Now, there are a few different ways interest is calculated, but it can be broken into two categories: simple and compound interest. Let's start with an example using simple interest, as it's a bit easier to understand. Imagine you borrow $1,000 from a friend. They're super nice and only charge you a 10% annual interest rate for 1 year using simple interest. That means on top of the $1,000 you borrowed, you'll owe them an additional $100 in interest. So when you pay them back, it'll be a total of $1,100. We will go into those calculations shortly. Compound interest is a whole other beast, and we'll tackle that later. But for now, just a reminder that simple interest is like a flat fee you pay for borrowing money. Okay, so we understand that simple interest is the extra cost you pay for borrowing money. But how do you actually calculate it? Here's where a handy little formula comes in. Don't worry, it's not scary. This formula, I equals P times R times T, helps us figure out the exact amount of interest you'll pay. I stands for the interest you'll pay. P represents the principal amount, which is the actual money you borrowed. R is the interest rate, but here's the catch. We need to convert it into a decimal first. Most of the time, interest rates are shown as a percentage. So, for example, if your interest rate is 10%, you'd divide it by 100 to get 0.10. Finally, T represents the time period of the loan, usually in years. By plugging these numbers into the formula, you can calculate the total interest you'll owe on your loan. To go back to our example, I equals P times R times T. I equals $1,000 times 0.10 times 1. I equals $100. This is how we calculated the amount you would have to pay your friend back. So far, we've covered simple interest, which is pretty straightforward. But there's another player in the game, and this one is the real game changer, compound interest. To go back to our example, imagine you borrow $1,000 from a friend. They're super nice and only charge you a 10% annual interest rate for 1 year with interest compounded monthly. That means on top of the $1,000 you borrowed, you'll owe them an additional $104.71 in interest. So when you pay them back, it'll be a total of $1,104.71. So where did the extra $4.71 come from? Compound interest. Compound interest is like magic. Well, almost. It's often called interest on interest. Basically, it means you not only pay interest on the original amount you borrow, the principal, but also on the accumulated interest itself. The formula for compound interest looks a bit more complex, but don't worry, we don't need to memorize it. Think of it like a snowball rolling downhill. It starts small, but as it gathers more snow, it grows bigger and bigger. That's how compound interest works. The longer your money sits and earns interest, the faster that interest grows on itself. We'll see how powerful compound interest can be in a few minutes. But first, let's talk about a handy tool that can help you understand your interest costs for a specific example of mortgages: online calculators. Alright, so we've been talking about simple interest and formulas, but let's get real. Where does this hit us the most? Mortgages. Buying a house is a huge financial decision, and a big chunk of your mortgage payment goes towards, you guessed it, interest. Since mortgages typically have long repayment periods, often 15 or 30 years, even a small interest rate can add up to a significant amount of money in the long run. There are different types of mortgages like fixed rate and adjustable rate, which can affect the interest you pay. We won't dive too deep into that today, but just know that the longer you borrow and the higher the interest rate, the more you'll end up paying for your dream home. Phew! Interest can get a little complicated, but thankfully there's a way to make things easier. Forget the fancy formulas. We have amazing tools at our fingertips. Thankfully, you don't have to be a math whiz to understand interest. There are tons of free online interest calculators available. Just a few clicks and you can see exactly how much interest you'll pay on a loan depending on different factors. There are many others out there for online calculators. Just do a quick search online and find one that works for you. These calculators are fantastic because they allow you to experiment with different interest rates and loan terms. You can see how even a small difference in interest rate can make a huge impact on your total repayment amount when you compound it over the life of the loan. It's a great way to compare loan offers and make informed financial decisions. Alright, so we've talked about the concept of interest and how online calculators can help us understand it better. But how much of a difference can interest rates really make? Let's see this in action. Imagine you're borrowing $250,000 and putting 20% or $50,000 down on a mortgage. This interest rate for this example is 2.5%, or much what was seen in 2021 and 2022. Now, if we plug this into our handy online calculator, we can see that over 30 years, with a 2.5% interest rate, you'd end up paying around $84,478 in total interest on top of the original $200,000 loan amount. But what if interest rates go up? Fast forward a few years and imagine the average rate is now 7.5%, similar to what we are seeing today in 2024. Let's see what happens with the calculator again. With a higher interest rate of 7.5%, the total interest paid over 30 years jumps to a whopping $303,434. So borrowing the $200,000 costs over $219,000 more at 7.5% than at the 2.5% rate. In fact, it costs more to borrow the money than the original amount of money borrowed. As you can see, a seemingly small difference in interest rate can translate to a huge difference in how much you end up paying in the long run. That's why it's crucial to shop around and compare interest rates before you borrow any money. Even a fraction of a percentage point can save you thousands of dollars. Remember, understanding how interest works is key to making smart financial decisions. Whether it's a car loan, a mortgage, or even a credit card purchase, knowing the interest rate can help you avoid unnecessary debt. So take action, research current interest rates, and shop around for the best deals before you borrow any money. A small difference in interest can make a huge difference in your wallet over time. If possible, explore debt-free alternatives. Saving up for a down payment or buying a less expensive car can save you a ton of money in the long run. Thanks for watching. If you enjoyed this video, leave a comment below and let me know what other financial topics you'd like to learn about. Don't forget to subscribe for more money-saving tips.